I want to be in the best frame of mind, making the best long-term decisions for our investors. And so whether it's things like physical exercise or meditating, just things that help me, be a little bit better and in a better frame of mind day to day. I think all those things help create great alignment. But you're right. The fee structure is one that I hope creates some great alignment with everyone.
So Jeremy is the chief investment officer of Right Tail Capital. And one of the coolest things that I came across when researching you was your fee structure. I've always loved Buffett's 0-6-25 fee structure that you've adopted. Can you break down the fee structure in a little more detail and discuss why you think this is the optimal way to align yourself with your partners?
Sure, I'd be happy to, Kyle. So I remember hearing about this fee structure years ago, and it always just kind of jumped out to me as something that is unique and could potentially create quite a bit of alignment. So first, what the fee structure is exactly what you said. So there is no management fee. As you know, in the investment management industry, management fees are pretty common. And so the only way that Right-Tail will generate a fee under this structure is to have positive performance. And that performance needs to be over 6% per year. And if it is over 6% a year, then Right-Tail's fee ends up being 25% of whatever performance is above 6%. So, for instance, if the returns in a year were 10%, you would just do a simple 10 minus 6 is 4 times 25%, and the fee to Right-Tail would be 1%. Now, you mentioned the concept of alignment and also the concept of fee structures. And in my opinion, there isn't really a perfect fee structure. I'm a big fan of Morgan Housel and his book, The Psychology of Money. And he does a great job of describing how we all have very different feelings and histories towards money. And it's probably, just decades of, what did our parents teach us and our grandparents, and what did we grow up with and not grow up with? And so, I'm very just cognizant that I'm not going to be able to create the perfect fee structure. And I don't think that a fee structure is the only way to create alignment. So there are several ways that I've tried to create great alignment at Right-Tail. One is just my wife and I continue to be the largest investors at Right-Tail, both in terms of the dollar amount, and likely we'll always be the number one investor in terms of percentage of our net worth. So for me, that's like a really important way that I'm aligned with all of my investors. But then it also gets into like just simple day-to-day habits of, I want to be in the best frame of mind, making the best long-term decisions for our investors. And so whether it's things like physical exercise or meditating, just things that help me, be a little bit better and in a better frame of mind day to day. I think all those things help create great alignment. But you're right. The fee structure is one that I hope creates some great alignment with everyone.
Yeah, I really like those intangible ways that you've created an ability to be, truly partnered with your partners. But I'm interested in knowing. So I look for people using your fee structure, and I can probably name the amount of people that I know of that do it on one hand. So it's not very popular. So I'm interested in knowing why you think this is such a kind of rare way to structure a fund.
I know you're a big fan of Monis Fabrai, Kyle, and I remember hearing him speak once years ago on a podcast and just talking about how he used the same fee structure and how he has positively cloned, a lot of the great things that he's learned from Buffett and Munger. And, he was talking about the fee structure. And I remember him saying something along the lines of, well, I tell everyone who's thinking about starting an investment firm to use this fee structure, and it creates good alignment. And if you do it, good things will come over time. Like it may be hard to think of not having a management fee, but good things will happen over time. And then he goes on to say, no one ends up doing it. And having lived, through having this fee structure for the last almost 2 years, I would surmise that maybe people don't do it very often because it is hard, to not have a steady stream of income. And for most folks who decide to start an investment firm, they likely have done a good job at investing, and there's something that has given them confidence, and hopefully there's a deep passion there as well to want to go out and kind of share their investing talents with other folks. But a lot of us have not run a business before, and a lot of us have probably had, some, maybe a lot of success in our past lives, both in investing and in our school studies and things like that. And so, for me, where day one, I was managing maybe $3 or $4 million and had 3 or 4 investors. There are some challenges, and it takes a little bit of a rewiring to go from being paid well and having sort of a steady salary and a year-end bonus to kind of saying, well, I'm not really going to get paid at all for the time being. And it really is going to be based on performance. So I would guess that one of the reasons that, people don't do it is because it's just kind of very hard to stomach that. And then secondarily, I've seen a lot of folks who have started investment businesses who have invested a lot in the business. Either they've built a big team up front, or they get the shiny office space in Midtown Manhattan, wherever it might be. And that can create a certain amount of pressure as well. And it may even create so much pressure that it changes your investment outlook, or it changes how long term you can really think. And so I was like, look, I don't want to do any of that. I want to keep expenses low. I can hopefully do the best job possible within the framework of this fee structure and create as much alignment as possible. But that would be my one guess as to why maybe more people don't do it.
Makes sense. So I know you actually do have a fee only option for your services as well. What made you want to add this feature to your services?
Sure. It goes back to a bit of what we were discussing with just, kind of each individual maybe having different preferences regarding money and investing. And a really close friend of mine who works at an endowment, I remember, years ago, he was saying, hey, you might just want to offer investors a choice, like people might appreciate that. And so what I tried to do was to come up with a fair management fee only option that would hopefully have the two structures be, relatively equivalent. And so what I kind of came up with was a 1.25% management fee. And so the break even between the two structures in any single year would be 11%. And there have been some interesting takeaways and surprises of kind of offering the choice. One, I would say my ability to predict what someone might choose is near zero. So that's been kind of fun and just kind of interesting to see. And then another thing that has surprised me is just, that where I sit today, and I'm fortunate to have 46 long-term like-minded investors who, have invested alongside me. And we're roughly, 50% in one fee structure, 50% in the other fee structure. So hopefully that, that lends some credence to maybe the structures are relatively comparable. And then I really just want each investor to pick the one that will make them happiest in however they kind of think about things.
Yeah, that's a great answer. So you alluded earlier that, that with your fee structure, you can't have a cushy corner office in Midtown Manhattan. Whereas some of these more AUM based fee structure companies, they can afford that because they have a lot of money coming in, and that's just the way they run their business. But with the way you run yours, what kind of general differences do you see between the way you run your fund and some of these more AUM based fee structures?
Well, I could certainly speak about how I do it, Kyle. And in general, I just try to be very thoughtful around, where I would like to, allocate investment dollars or expenses. And it all kind of works well for me, and I believe gives me the best odds of, showing great long-term investment performance. So for the time being, I have a home office and I really enjoy working from home. As you know, a lot of what I do on a day-to-day basis is reading and thinking. So, I kind of need a quiet, comfortable space, and working from home works really well for me. And I was very fortunate to have, some experience working from home, largely due to COVID, because before that, I wouldn't have guessed that, I could be as productive working from home. So that would be one thing that I would mention, as maybe something where I could see, potentially having an office or some shared office space or something in the future. Um, but I love my current setup. And then when I think about where I do want to kind of allocate expenses, it's really with, kind of my investors' thoughts in mind. And it's, being thoughtful about um, different research services I subscribe to, and things of that nature. Um, but I have everything I need. So, I feel like it's set up well. And I often think about, Buffett has a great line about, more about when he's analyzing two businesses in the same industry. And, he'll kind of say, well, gosh, like one might have a cost structure that's like 50% of the other companies in the industry. And we might all say they're in the same industry. And Buffett makes the point that no, they're actually like two very, very different businesses. And why that's important when, folks, think about Rightail, or when I do, is just that I've set the business up to just give myself incredible long-term investment duration and staying power. And so, a lot of these, little decisions, end up being very important.
So you mentioned in a previous interview that you aren't a fan of putting yourself into a value or growth bucket. So I tend to agree with you on this, as value and growth are both important to success in investing. And you can get value in both high and low growth businesses, just as you can overpay in both high and low growth businesses. So I'm interested in just understanding a little bit more about how you factor this into the types of investments that you make.
Sure, sure. It's funny. I think about all the investment management interviews I've done over the years, and some of them I would get asked pretty often, what type of investor are you? Are you value or growth? And I didn't really have a great answer at the time. I knew that I was like very uncomfortable every time that question was asked, because in my mind I was thinking, you know, one, I'm pretty flexible, but, aren't we all just trying to find like good investments, that are going to, make money over time? And so, yeah, and Buffett has talked a lot in his letters about both value and growth being very important, to how you would even, potentially think about valuing a business or considering an investment. In super simple terms, I really want to find an above average quality business and buy it at a fair to below average price. That's all I'm trying to do, in simple terms. And we can get into, more details around how I think about that. If I have to pick one over the other, I care more about the quality side than the price side. But, I always want to be thoughtful to each situation that I see. But in general, I want to find high quality businesses and allow them to continue to create value for Rightail and for us shareholders over many years at a time.
Great. And so you mentioned there that you like buying at a price that's, hopefully at or below the price of the market. So I'm interested in knowing how you mitigate risk by, using the price that you pay for a business.
Sure. Well, I love a lower price, and I've had many colleagues over the years who might define themselves as like a more traditional value investor, which I would define as maybe a low price to earnings multiple or some sort of near term valuation metric that is jumping off the page as being low. And so, I've mostly, kind of learned and been fortunate to work with folks like that. And so I love a lower price. There's nothing wrong with that at all. Would love to find a fantastic business at a very cheap multiple. Um, but again, I just really focus on, paying a fair, and hopefully it ends up being kind of a below average price for each great business. I also think there's a lot of margin of safety. The price that you pay is one, sort of factor of margin of safety. Another, I think, is the quality of the business. So a lot of the businesses that I own, Kyle, have great balance sheets. They have great management teams, and they have certain competitive advantages. And oftentimes these businesses, because of how they structured themselves and because they're not so worried about how they're going to pay off their debt and things of that nature, that when tough times do come for the economy or that industry specifically, a lot of times these companies can actually play more offense than their peers can. And that's exactly what I think we should be rooting for, as long-term investors. And so what I've kind of found is, a lot of times there's a great margin of safety in, just having these awesome businesses that will figure out ways to win and gain market share when everyone else, maybe is playing with one hand tied behind their back or something like that.
So I think most investors have a few general principles when it comes to their core philosophy. You already kind of shared that you obviously place a massive emphasis on quality, but so for instance, someone like Chuck Ackrey, he has his three-legged stool, which I'm sure you're familiar with, which is, buy extraordinary businesses with talented management, with great reinvestment opportunities and histories. So I'm just interested in knowing, outside of quality, what is kind of the essence of your investing philosophy?
Well, I think you kind of hit the nail on the head, Kyle. That is a lot of it. When I think about quality, I think about a couple of things. So one, quantitatively, the two things that I care a lot about are how long is the company's reinvestment runway? And then secondly, what incremental rates of return can a company invest their capital? So the companies we invest in, they're producing cash flow each year, and then they can decide what they want to do with their cash flow. And I want to find the companies that can, invest that capital thoughtfully and intelligently, and have it produce even more, capital and cash flow for us. And if that happens, we'll end up creating a lot more value that way. So again, quantitatively, I care about the reinvestment runway. I care about the returns on incremental capital. Now, there's a lot that goes into that qualitatively, but a simple way to frame it would be to say, that I want to invest in companies that have sustainable competitive advantages or some sort of moat that allows them to generate these high incremental rates of return. Because as we all know, we live in, a capitalist economy, and whenever there are good rates of return, that is probably going to attract, more capital and more competitors. And so it really does. There need to be, things that are special that allow, these positive characteristics to exist and to exist for many years in the future.
Yeah, agreed. So I know that you own two investments that are both excellent performing stocks and great businesses, but go about allocating capital in slightly different ways, which you kind of just discussed. So these two names are O'Reilly Auto Parts and NVR. So I'm interested in knowing, how do you forecast the future fundamental developments of these businesses in terms of growth and capital allocation?
Yeah, it's a great question. In some ways, I would say that O'Reilly and NVR have a lot of similarities. So they're both companies that I've found to be very much kind of long-term thinkers, in terms of how they plan, in terms of how they allocate capital. Both companies tend to have employees who have been at these companies for very long periods of time. And we could maybe guess like some reasons why that might be. One is, I think they both have a history of success, so it's probably a bit of a fun environment to be in when you work at a company that's been very successful. Um, O'Reilly is kind of interesting because, they're based in Missouri, and, so maybe they have certain advantages just based on where they are. But they've done an awesome job. Their new CEO, is someone who is young and has a lot of energy. And I believe his first job at O'Reilly was right out of high school, basically helping to unload some of the trucks. NVR is, headquartered, maybe an hour and a half, 2 hours north of where I live in Richmond, Virginia, and has a big presence in the area. And so I've been fortunate to meet longer tenured employees who work at NVR, and kind of same thing there. There are certain things that NVR does from a compensation standpoint, like they tend to issue options every 4 years. And so just in terms of, having these options that vest over a longer period of time, I think that perhaps creates a bit of long-term thinking as well. So those are maybe some of the things they have in common. You're right. I would say they allocate capital a little bit differently. O'Reilly is often building new stores or investing in their distribution capabilities. And if we were to look at their financials and look at, the last 10 or 15 years, their returns on incremental capital have been phenomenal. I used to think of that industry as one where O'Reilly and AutoZone and Advance Auto Parts, as the three bigger players, I used to think of it as they were all kind of slowly gaining share from the mom and pops who maybe have less scale, or maybe they could carry, less inventory during a challenging period like COVID when supply chains were disrupted. The mom and pops likely have less advantageous financing terms and things like that. But, more recently, things have changed where, Advance has likely had some challenges for a long period of time and has been a more acquisitive company. And now it looks like O'Reilly is gaining share in a big way from Advance, and probably even, maybe gaining some share from AutoZone as well, which is also kind of a well-managed and really great company. To segue a bit to NVR, so it's funny. Both of the companies repurchase a lot of shares. Both of the companies have done very few acquisitions, although with O'Reilly, you could, point to some. There was one that they did about 15 years ago that ended up being a home run, but these aren't companies that are doing acquisitions every year. And NVR is just, very, very thoughtful around, they kind of came up with a different model about 30 years ago after almost going bankrupt during the savings and loan crisis. And they ended up feeling like owning the land that they build their homes on was kind of the riskiest part of the capital allocation framework for a home builder. So they said, hey, we're not going to own the land anymore. what we're going to do is work with local land developers, and we'll buy an option to build on the lots that they develop. And they end up probably paying a slightly higher price for these options, but the flexibility that it gives them, kind of far surpasses, whatever little bit they kind of give up in the near term. And they have just done a fantastic job over the last 30 years. It's been an amazing investment. I've been fortunate to be an NVR investor for much of the last 6 years. With O'Reilly, it's been kind of much of the last 4 years. So even predating Rightail, these are companies that I've been studying for a long time. So I'm happy to go into any more detail about those companies or how they allocate capital. But that's a bit of a summary.
What if in 2024, you got a little bit better every day? When you're learning a new language with Babbel, that's exactly what you're doing. And if Babbel can help you start speaking a new language in just 3 weeks, imagine what you could do in a full year. Babbel's quick 10-minute lessons are designed by over 150 language experts to help you start speaking a new language in as little as 3 weeks. Babbel's tips and tools are approachable, accessible, rooted in real-life situations, and delivered with conversation-based teaching so you're ready to practice what you've learned in the real world. Thanks to Babbel, I can start having conversations and order my food in Spanish at local restaurants when the situation allows. It's no wonder they've sold over 10 million subscriptions, and that studies from Yale, Michigan State University, and others continue to prove that Babbel is better. Here's a special limited time deal for our listeners. Right now, get 55% off your Babbel subscription, but only for our listeners at babbel.com/WSB. Get 55% off at babbel.com/WSB. That's spelled BABBEL.com/WSB. Rules and restrictions may apply.
Yeah, that's a really good summary too. I would love to know more about especially NVR, because NVR is kind of the poster child for share buybacks and creating tremendous shareholder value through share buybacks. So would you maybe be able to go through that in a little more detail for the audience?
Absolutely. It's funny. One of the things that is funny is, so NVR gets grouped with all the other home builders, and it was a bit like the Buffett quote that we talked about earlier. They do look a lot like other home builders. They build homes, but their businesses are structured very differently, and so NVR just has a lot less capital tied up on their balance sheet. And I've learned over time too, that while I think most investors associate NVR with this lack of land ownership and this asset light strategy, there are many, many little things that I think NVR does really well. And it helps them to kind of turn their inventory of lots faster. They come through on their commitments to the land developers. So I've talked to land developers who are like, look, I've worked with all the big guys, including NVR, and NVR always does an amazing job of kind of doing what they say they're going to do. And so I don't mind having a bigger portion of my business with them because I know they're going to get it done on time. It helps me plan my business. And I bring all this up to say that a lot of times when I see sell side analysts talk about the home building industry, they'll often make a relative value comparison and say, well, gosh, like the other home builders trade at 1 times book value, or they trade at 6 to 8 times earnings. And then you look at NVR and the multiples that it trades at are much, much higher. Okay, so that's one point. The second point would be, well, we could look at NVR's stock price performance over pretty much any period of time over the last 30 years. And even if you said, well, gosh, it's not fair to look at some of those early years where they were going through a business model change and there was a lot of risk and the investment community couldn't understand it. Well, I would say, well, it's been very clear, for a good portion of that time, maybe at least the last 20 years. And the NVR stock price performance has just been phenomenal. So we have this issue where the valuation looks is optically higher, but the stock price performance has also been really, really amazing. So, I would say the market has never really had the valuation correct for NVR. And it's a business that, historically has had returns on invested capital well north of 30%. And even though it's traded at a big premium to the other home builders, it has still, during most of that time, largely traded at a discount to kind of the average company in the S&P 500 business. And I would say it's a well above average company than most of the companies in the S&P 500. Albeit it can be cyclical, right? When we came out of the great financial crisis, it was there were less homes being sold because we just had too much inventory. So we do need to be, kind of thoughtful around the cycles. But putting that aside for a second, NVR has taken all this cash flow and has just rebought or just repurchased many shares over time. And I won't get the number exactly right, but I think today NVR has maybe like somewhere around 3.5 million shares outstanding, which is just an absurdly low number, and it's one of the reasons. Of course, they could have chosen to split the stock or something at some point, but it's one of these unique stocks that has a really high share price, around $7,000 a share, but that share count is about as low as I could think of for kind of a decently sized publicly traded company. And you're right, they've created a lot of value by just repurchasing their shares over a long period of time.
Excellent. So I know you're a fellow fan of concentrated portfolios like myself. So I'm always interested in learning more about investors' past and kind of why they settled on concentrated portfolios, because, it's not something that you necessarily learn in school. I mean, it's kind of something that you learn just from studying the greats yourself, I guess. So I'm interested in just knowing, why was it that you settled on a concentrated portfolio of, say, 8 to 15 names that you're at now?
It's a great question. And you're right. We typically don't learn this at school. We normally learn about the benefits of diversification. And it's interesting because most of the literature I've read, suggests that a lot of the benefits of diversification, especially if you're not investing in, the same business across all the stocks, but you get a lot of the benefits of diversification once you kind of hit 10 stocks or something around that. So that's one thing that I find interesting. But concentrated investing has always just felt very natural to me. It took me a while to be able to articulate that. But what I kind of noticed over time was, for example, I worked at Rowe Price out of Harvard Business School, and T. Rowe is a fantastic firm. There, I was only covering kind of a few industries, so I wasn't a generalist like I am today. And I was probably covering 30 to 40 companies in those industries where I was kind of tasked with kind of being, the expert on these companies. Contrast that with what I was doing in my personal account, which, at any period of time, I probably had 10 or 12 investments that I thought were really going to be exceptional. And that always felt fine. And, so I would say, look, with a lot of investing, there are many ways to make money. There is no, kind of one right answer. But I think a lot of investing is kind of a personal journey to figure out, what makes the most sense for each of us. And so, somewhere in that 8 to 15 range is the sweet spot for me. And today at Rightail, I own, 13 different positions, and it's fantastic. It allows me to concentrate my time, on these names. when I find a new name, which I'm sure we'll spend some time talking about, I can compare it to the 13 I already have and try to find a new investment that will come in, well above what I think the return potential of the average holding could be within that 13. And then when those investments do well, one of the benefits of a concentrated portfolio is that it can have a really punchy, impactful performance on the returns. And also, no position is so big that I'm losing sleep about it at night, or that when something goes wrong, because things will inevitably go wrong with some of these investments. It will have an impact on the portfolio, but it'll have like a modest impact. And then if we think really long term, I would expect that, it'll probably be more like a handful of these investments, or maybe even a slightly lower number, that will really have just the dramatic positive impact on the portfolio. So on the downside, if I have an 8% position and it goes down 25% and we lose 200 basis points or 2% of performance, that may not be fun in the short term, but I think when we're looking back on it 10 years from now, we'll probably be talking about the companies that, have grown to be multiples of the original value that we invested. And those will have a much bigger impact on kind of the overall return profile.
Excellent. So a question I'm fond of asking professional investors like yourself is how they prefer to enter positions. Do you like taking, smaller positions to start and then adding as you gain more and more conviction and knowledge of a business? Or are you, just kind of piling money in as fast as possible to get to your desired, let's say 8% position size?
It's very situation dependent, Kyle, and it's a great question. For me, it's situation dependent based on a few factors. One is, I would say prior knowledge of the business and industry. So if it's a business that I really feel like I know well, or maybe I've invested in it in the past, that would maybe make me a little bit more comfortable in terms of making it a slightly larger position upfront. And so that would be one factor. The second factor would be, just how great of an investment do I think it might be? If it looks incremental to the portfolio, and like I said, trying to find ones that are not better than the 13th position in the portfolio, but hopefully kind of more in the top half, which is kind of another way that I think about, kind of margin of safety and avoiding incremental thinking. But if it really looks exceptional, that might argue for a larger position as well. But I've learned over time that no matter how much work I do upfront on a business and the industry that it's in and its peers, there are always things that I, kind of overestimate or underestimate. And I learn more, as I own the business and as I get, kind of more reps with the company and just kind of understanding what they do. And so, that is something that over time where I've kind of said, hey, I'm open to starting off with a larger position, but a lot of times, I may just start with, something that's maybe around a 5% position where, it's still a reasonably sized position. And over time, if things kind of unfold, positively, and most of the things that I thought going in kind of play out, I'm totally fine, kind of adding to the position, even if it's gone up a little bit, provided that I think the long-term opportunity continues to be there for exceptional returns.
Yeah, that's a great system. So I'm also interested in knowing what is the desired market cap, let's say, of your dream business?
I'm very flexible when it comes to market cap. But if I really were to say kind of the dream business, and I would hope that when you and I are talking again in 10 years, I would hope that I've found an extra one or two smaller businesses to invest in. And if I can do that, and I think I'll be able to over time, if I can do that, then, who knows, like that could imply that there's a longer reinvestment runway. If it's a smaller business, it may be kind of less well known, less discovered, and trade at a less expensive valuation. That would be attractive too. So those are kind of all the positives. But I'm also, I also go in with a fair amount of skepticism around smaller companies as well. Some companies are small and they tell an interesting investment story, but you look at the history and they've been small for a really, really long time, and and old habits and industry structures and things, those are hard to change, not to say that they can't. So when I'm going through and doing the analysis, I do want to be able to study the history of the business and how the returns on capital have kind of evolved over time. And sometimes, not always, sometimes there's a bit more history and it's a bit easier to study for a business that's slightly larger. So I would say, I really am very open-minded, and I don't mind investing in larger businesses that can still compound at, kind of a mid-teens or higher rate of return over kind of a multiple year period. That being said, I'm hopeful, as we talk in many years' time, that I'll have found, one or two additional smaller companies that might have all the benefits of those larger companies, but maybe even have a longer reinvestment runway and higher return potential.
And so just for the audience, what would you consider, because, different people have different definitions, but what would you consider a small company in terms of market cap?
My smallest investment today is probably around 5 billion of market cap. So I would probably put a range on it of, maybe 500 million to 5 billion in market cap, something like that.
Excellent. So depending on the levels of turnover that a portfolio manager has, they may have a great year making, 0 investments, or they may consider it a great year making dozens and dozens of investments. So you're obviously concentrated, so I can kind of guess where the answer is going to be here. But how many new investments do you try to add per year, and what would a perfect year look like?
It's an awesome question. So I underwrite each position over a potential 3-year holding period. So, if we were just to say, hey, what's, 12 or 15 or whatever number of investments in the portfolio, divided by, 3 or, something along those lines, it would kind of suggest that, maybe in a given year, there are only a couple of new investments. So I often kind of describe it as, kind of saying, hey, I think it's probably 0 to 3 new investments per year. I recently made a new investment, but prior to that, I really hadn't made one in about a year. So that's just one example from a very small, kind of sample of time. But the goal is really not to have a specific number of new investments a year. One, I would say the goal is really to just get more knowledgeable on different businesses and different industries. And each year that goes by, to be able to share with you, hey, these are the industries where I feel like I've learned a lot over the last year. And that may be helpful for a new investment. It may be helpful for a current investment where, I learned something or about some type of idea that I could apply to the rest of the portfolio. Or it may be some learning that really comes to fruition in several years of time when, maybe a new opportunity comes up or the price drops a lot, whatever the case might be. There are a lot of ways that I think kind of building that library and knowing more industries, in a more knowledgeable way can just really, really benefit over time. The other thing I'd say about the topic of turnover is, when I look back over my career, some of the times that have been most fruitful for finding new investments is when there are kind of a lot of challenges and kind of weaker performance in the market. So, the early period when COVID kind of, first happened in kind of, early 2020, that really just kind of created some amazing investment opportunities where, there was a great business and a great management team and a great balance sheet. And all of a sudden, for whatever reason, the stock was down 50%. And if you could, get some level of conviction that the business had enough cash to survive, a very challenging, period of time, and that their competitive advantages were going to be at least as strong or maybe, even get stronger. That, an example like that, or that, that type of period where there's a lot of dislocation, there might be even, more turnover because you just have this very rare opportunity to really upgrade the return potential of the portfolio. Those are rare, but they absolutely happen. And, I want to be, kind of ready and willing and knowledgeable enough to act when those opportunities come up.
So I wanted to move on to evaluation because you have some interesting evaluation methods that I wanted to go into. So you mentioned that you'll break down the internal rates of return of a potential investment using some simple bond math. So I'm interested, can you please detail this evaluation method for the audience?
Sure. And feel free to ask any questions if, if I get a little too in the weeds or I'm not describing it well. But simply we're always trying to figure out what cash flows an investment is going to produce over its lifetime, and then kind of value those cash flows. And one way to do that is to try to think about owning an equity like you might think about a bond. And so, the way owning an equity can be similar to a bond is if you say, all right, well, what is the coupon payment that the bond, kind of pays to the owner each year or a couple times a year. And so I would say that's very similar to the cash earnings that the stock or the company generates. So the cash earnings yield for the business. And then the second component would be, okay, well, for a company, those earnings might grow over time. So, what's the current cash earnings yield? And then how might we evaluate the future growth? So that would be to just keep it simple and think of it in two ways. And then we can further break down that growth component, which I think is, a really fun thing to think through. And so that growth component, I would say we could break down into two factors as well. The first factor would be growth that the company can achieve without reinvestment. And so good examples of that type of growth would be, something like Moody's bond rating business, where they have this dominant position in the market. There's probably going to be a little bit of volume growth in the market over time. Maybe it's 1%, 2%, 3%. And because they're so dominant, and because, having a rating from Moody's or S&P helps lower the interest rate that an issuer of debt might achieve, well, they could raise the price a little bit each year because it's still kind of a great value for the issuer of the bond. So, Moody's, they'll grow a little bit without arguably really needing to reinvest. Another example would be Visa and MasterCard, where they've grown for a long time, just as so much of the world's, payment has shifted from cash to credit cards, and they have the credit card networks. That's the first component of growth. The second component of growth, some companies have both, some have one or the other, some have neither. But the second component is the reinvestment component. And so there, what I try to do is say, how much can this company reinvest each year? And at what rate of return can they reinvest? So, to use some simple math, let's say a company could reinvest $100 at a 20% rate of return. So you'd multiply those two numbers together, you'd come out with $20. So that's effectively $20 of new earnings. And then you could capitalize that new earning stream that is hopefully being created each year by the company's reinvestment, and capitalize that at some earnings multiple. So to wrap it all up, I would say, you can look at this bond math and kind of say, all right, cash earnings yield plus growth without reinvestment plus growth from reinvestment. And I add those up and I get to a potential IRR for the investment. And that's one way I like to look at valuation. And it has been very beneficial for me, particularly thinking through the growth components and especially that reinvestment component, because I think that is a piece of the analysis that often gets lost when investors are just talking about, well, company A trades at a 15 times PE and company B trades at a 20 times PE. And when you really try to go through some of the reinvestment math, it just kind of shows how great companies, even if they may look to be a little bit more expensively valued, can still be the better investment over many years.
Yeah, I love that point. Chris Mayer was telling me specifically about that, how, you can look at two businesses in the same industry that, maybe are competitors, and one might be just extravagantly priced on PE, price to earnings or whatever. But when you look at the ability to reinvest at high rates, it makes a huge difference. And, you can pay optically a much higher PE multiple for one business, and it could still be, the better deal than paying for the cheaper one.
It's a fantastic point, and it's a lesson that I learned so many times over the years and learned it the hard way, where, it's often easier, I think, especially when we're, first exposed to investing, where if you're maybe studying 3 companies in the industry, well, why wouldn't you want to invest in the one that trades at a cheaper valuation? And especially if that one that, is at a cheaper valuation, especially if there's a new management team or they're trying some new procedures that are going to help them close the gap to where that number one player is. And so you can look at one of those companies and come up with the case of, wow, well, their earnings are really going to improve and maybe the valuation will improve too. And that'll be fantastic. And what I kind of consistently saw over time, and obviously there are exceptions, but sometimes I'd come back a few years later and I'd look at that industry again and I'd say, well, gosh, that company that I thought was the best, it's still the best. It still appears to trade at a more expensive valuation, and it's been the best stock performance of the 3 companies. And, so after, making that mistake and learning that lesson several times, it was just a great learning, and one that, fits with who I am, as a person. And, just the same way that I want to try to continue to get better, and have lots of good habits and disciplines that help me do that. I typically want to invest in companies that are very consistent and do a lot of little things well. And going through this bond math that I just described is one way to, help put some numbers around something that can be very hard, which is like kind of a quality, it might be easy to say, well, this is the best company in the industry, but it's not always easy to say, okay, well, this is actually why, based on the numbers, it might end up being the best investment. And that's one thing that's very important for me to try to think through.
Yeah, I love those insights. So you've also mentioned that you do have a couple of other evaluation criteria that you use, in just kind of a discounted cash flow and using just multiples. So you don't have to go too into depth into these, but I'm just interested, are you using all 3 of these kind of in conjunction to make sure that your evaluation is kind of directionally correct? Or, do you weight one higher than others? I'm interested in knowing more about that.
Absolutely. So I think through all of them, for me, one of the areas of thinking through that bond math example, where I get uncomfortable is if the multiple is too high, if the current multiple is too high or the cash earnings yield is too low. And so, maybe there's an example, like if we think of a lot of software businesses a couple of years ago when they were trading at 30 times sales, and, you could argue that they were cash flow positive and they were just kind of investing the cash flow through the income statement. But, they're trading at these really, really high valuations. And so someone I think could look at, some of this investment math and say, well, they are reinvesting at high rates of return and the industry that they're in is growing. And so don't worry about the cash earnings yield not being there. It could still be a good IRR. And so thinking through the current multiples or also putting the numbers through a DCF, it will probably make a potential investment like the one I just described. It'll be a good gut check that might say, well, gosh, like it looks like it's going to be really hard to make money with this, type of investment. So, there's no, kind of, I wouldn't say I use, each of the different methods as a certain percentage of the decision because there's so much that goes into it. I need to feel like the company is high quality and is sustainable and hopefully improving over time. But I do like to think through those different methods as, just kind of a bit of a soundness check to say, kind of, does this seem reasonable? And, if so, if more of them line up, then, there might be a slightly higher chance that, the investment ends up making it into the portfolio.
So in an interview from March of 2023, you said that all your investments were in North America, most in the US, with one being in Canada. So I'm just interested, is this a circle of competence thing, or are you willing to eventually invest abroad once you, if you know that the country that you're investing in has regulations that are supportive of shareholders?
That last thing you said, Kyle, is incredibly important. So I want to make sure that I understand the rule of law in any place that I would invest. And, the US is one area where, I feel like we do have really good laws and, it's a place where entrepreneurship is encouraged and intellectual property is largely protected. And, so those are kind of fertile ingredients that, can lead to good kind of economic value creation over time. And so you're right. Today I have investments in the US and Canada. I feel like I have a good understanding of those places. I'm open-minded to investing in other geographies, but I would need to feel like I, had a pretty good understanding that the country was, more similar to the US than different. So is it possible that, Rightail, we could end up owning, a business based in the UK or, somewhere in Europe where, I feel like we really understood things? Yes, I think that's, definitely possible. I would say what's probably less likely would be, to invest, in an emerging market where, rightly so, there might be better potential for longer term growth. But if I don't understand kind of the rules that we're playing by, to me, it's just easier to kind of avoid what I don't understand because there's great opportunities in the places that I do understand.
So you noted in a previous interview that you tend to stay away from biotech, and I'm 100% on the same page as you here. But I'm interested in knowing some other areas of the market that you just flat out refuse to invest in, and briefly describe why that is.
Sure. In biotech, it's fairly simple. I think understanding the science can be really important for a lot of biotech investments. And I've been fortunate to work with other biotech investors who are trained MDs, who've gone through medical school, understand the science, and I think can do a darn good job of saying, well, hey, the market seems to price in a 20% chance that this drug will get approved or whatever the case might be. And I actually think it's 50%. And, if I have a bunch of these small bets where I think the odds are really kind of aligned in our favor, then, I'll do really well over time. And that's just not a place where, I feel like I have the knowledge to invest there. Another area would be something like metals and mining, or something that I think is like very, very commodity dependent, where, in general, when it comes to big macro factors, I think they're really, really hard to consistently get right. And for a mining company or maybe an oil and gas company, arguably the most important thing will be the price of the commodity. And one of the things that's kind of funny about the metals and mining topic is my first assignment at T. Rowe was actually covering metals and mining. And, I had a lot of great experiences, got to meet a lot of awesome people and travel around the world and visit potential mines or mines that were in production. But, oftentimes these were small cap companies who were trying to build one mine, didn't have any in production, and they were just always raising capital, always telling a story. And there's so little they can actually control because, they can't change the actual rock. It's either going to be maybe as good as they tell you it's going to be, or a lot of times not as good. And I know, mining's a big industry in Canada, and so I can see you, likely have some experience with these companies, but that's just an area where, I want to invest in companies where I think I can understand what their advantages are and their ability to repeat those and sustain those. And so these are just some areas of the market where I'm not well equipped, or the businesses aren't well equipped to, kind of provide what I'm looking for. And I'll definitely miss some along the way because there will be great investments in these areas. But I'm totally okay with that.
Yeah, it's funny you bring up me being in Canada and miners. Obviously, we have tons of miners, but I'm lucky I came across that amazing Charlie Munger quote where when I first started investing, where he says, "A mine is basically a hole in the ground with a liar on top." And so that's kind of guided my my view on mining. So I stay away from them for the same reasons that you listed. But now that we know what you try and stay away from, can you share with the audience what you consider to be in the center of your circle of competence?
Yeah, I would say, kind of like what I said earlier, I'm constantly trying to widen that circle of competence and, find other industries that I understand really well. Certain industries where I have found a lot of these positive attributes. I have owned a few companies that are effectively distributors, but kind of serve different industries, different end markets. But sometimes you can find an amazing distributor that has a fragmented customer base and a fragmented supplier base. And to their suppliers, they're kind of an extension of the sales force and, can hopefully be very knowledgeable and a good representation of those brands. And to the customers, hopefully they can provide the right part on time, the knowledge to, educate the buyer on what part they actually need and should buy. And if they do all those things well, then, hopefully all their partners are really happy and they can earn kind of a nice economic return too. So sometimes there are great distributors. There can also be ones that don't have these qualities. So distributors would be one. Lots of areas of business services, software, so those are just a couple of areas where I have tended to find, maybe more high quality businesses over time. And then there can also be other areas that, maybe due to regulation or other areas can have certain moats, So I've studied the railroad industry in the US or, some of the waste companies and, so there are lots of different businesses and industries that can have, some of these positive attributes. And then kind of like what we were saying earlier with NVR, that's one where I think, maybe a lot of us would say, well, gosh, home building doesn't seem like a great industry. But then there's this one company in this cyclical industry that's kind of doing things in a different and special way. And that can be a really fertile area to find an investment as well.
Jeremy, just want to say thank you so much for joining me today. So before we say goodbye, where can the audience connect with you and learn more about Ridetail Capital?
Absolutely, Kyle. I thank you. It's been a pleasure, and I've really enjoyed our discussion. If folks want to learn more about Ridetail Capital, they can reach me in several different ways. My website is just www.righttailcapital.com. My email address is jeremy@righttailcapital.com. And I also post from time to time on LinkedIn and Twitter and other places. And really, I love to meet other folks who are similar, kind of long-term, like-minded thinkers who love investing. And that can be other, folks who, are running their own investment businesses, or people who work in some of the industries I care about. Or, maybe there's someone out there who is interested in learning more and potentially investing together. And, I just love to meet, kind of other great people who are trying really hard to get a little bit better each day. So those are some ways that they can find me.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
Rather than that I just bought 100 shares of Facebook or Meta on my Charles Schwab account, and I could sell them anytime I wanted to, you think I have just joined a business that will be around for 10, 20, 30 years, and I can't sell it, and I don't want to sell it. And I know there'll be trouble. I'm not going to respond to